Very good morning, everyone. Hope you all must be doing great. So in the last lecture, we were discussing mock test paper series 2. Series 1, we have already completed. In fact, if someone has missed the previous videos, I'll also share the link in the description so that you can easily find those videos as well. So regarding the series 2, in the last lecture, we were discussing MCQs portion, 15 marks. And out of the second portion, division B, we have already discussed the compulsory question number 1 that carries 15 marks. Now, from remaining 3 questions, we have to do only 2. So from question number 2, 3 and 4, guys, in your examination, you have to select only 2 questions. But as of now, since we are doing practice, so we will do all 3. So let's start. Okay, ready? These are our very easy questions, right? So see, it's very important. I always tell students it is very important. Just see, just reading the provisions is one part, but actually doing the question is most important. So if you practice questions, if you do questions, then actually you will be able to retain the provisions. You will be able to apply those provisions in your practical situations, in your questions as well. Right? So it's very important. These practice sessions, these MTP sessions, these are very important. And once you do this, everything you will get a good confidence, and then you find that this is very easy. Correct? So let's start with this. Okay. So Sagar is a chartered accountant. Okay. He's presently working in a firm in India. So this guy is working in India. He's a chartered accountant. He has received an offer for the post of Chief Financial Officer from a company at New York. So there is a company in New York. They have given an offer to this person, Sagar. As per the offer letter, he should join the company at any time between 1st September 23 till 31st October 23, sorry. So what these foreign guys are telling him that we are giving you sufficient time. We are giving you an offer letter, and there it is mentioned that Sagar, you can join anywhere between 1st of September till 31st October. We are giving you 2 months time to join. He approaches you for your advice. Okay, he's a chartered accountant and he's coming to us. He's coming to CA intermediate students for our advice. Very nice. So he approaches you for your advice on the following issues to mitigate his tax liability. So he needs our advice so that he can reduce his tax liability. Okay, on what points he wants our advice? First says date by which he should leave India to join the company. See, because New York company has given him 2 months to join. So he's asking by which date I should leave so that I can reduce my tax liability. Okay. Now it's very important that, see, if a person is a resident and especially ordinary resident, then his entire income gets taxable. Even if any income is accruing outside India or is getting received outside India also, in case of ordinary resident, it becomes taxable in India. Correct. But if the person is a non-resident, then we cannot tax foreign income, right? If it is not getting received in India, it is not arising in India, then it is not taxable in case of non-resident. Okay. Now tell me, on what basis an individual assessee becomes resident or non-resident? Sir, we know that's very easy. It depends upon the basic conditions. And what are those 2 basic conditions? That, sir, we all know. Okay. Let us revise them. First basic conditions says if the individual is there in India for at least 182 days or more in previous year, then this person will be a resident. Okay. Or there is a second condition also. If any of them get satisfied, the person would be resident. The second condition we all know, if the person during the previous year is at least for 60 days or more, plus in last 4 preceding years, 365 days or more in last 4 preceding years, then this person will become resident. Okay. We also know that in some cases, the second condition is not applicable. In those cases, we only see 182 days condition. We don't see these conditions. And one of the exception is if the person is going outside India, if the person is leaving, if the person is an Indian citizen and he is leaving India for employment outside, in those cases, we don't see this condition. We will only apply 182 days condition. And please tell me whether Mr. Sagar is coming under this category or not. The answer is yes. Because he is leaving India for employment outside. Now his employer would be a New York based company and he's leaving outside India. Right. Is he an Indian citizen? Okay. It's not mentioned, but we will assume he is a chartered accountant working in India. So we'll assume that he's an Indian citizen. We will write also. Correct. So first of all, if his number of days in order to reduce his tax liability, we will advise him become a non-resident this year. Tell me how he will become the non-resident. See, this condition will not be applicable. Only this condition we have to see. So we will say, please don't live in India. Don't be present in India for more than 181 days. Because if you will be there in India for at least 182 days, even if 182 days, you will be resident. So we will make him non-resident by suggesting him that please leave India before this 182 days arrive. That is at most you can stay here for 181 days. Okay. So in this year, he has to leave in September 2023 till 31st October 2023. So let us plan his number of days in such a manner that it should not go beyond 181. Correct. So how we should plan? Because anyways, he is here in India from very beginning. So from very beginning of the year, that is April 23, right? So he is here in April 23, May, June, July, August. Okay. How many days are here? In April, we have 30 days. May, we have 31. June, we have 30. July, we have 31. August, 31. How many days are here till August? Because anyway, he has to be here in India till August. Because that company is saying that if you want to come to US, you have to come on 1st of September. Okay. So let us check how many days are here. 30, 1, 2, 3, 4, 5, 150, 153 guys. So till here we are getting 153 days. Still we have time, right? Because we can make it 181, not more than 181. So to make it 181, what I'll do is I'll subtract this 153 from 181, right? Simple mathematics. So it is giving me 28 more days. So he can be here in September also for 28 days. So I will say, boss, if you would like to reduce your tax liability so that your foreign income doesn't get taxed in India, so by 28th of September, please leave. So I will say, because April, May, June, July, August, anyways, he is here in India. And till August, 153 days is coming. Maximum we can afford 181 days. So I have done a simple calculation. I have subtracted 153 from 181. I received 28. So I can say by 28th of September, please leave. Right. So in order to reduce your tax liability. So 28th September is the correct answer over here. Is it 29? Can it be 29th September? No, because if he will leave on 29th September, we understand the day when he leave, that will also be counted. And if he will leave on 29, then the number of days in India will be 182. And if it is 182, he will become resident. So it's better that he should leave on or before 28th of September. Okay. Second advice he is asking on this point, direct credit of part of his salary, okay, to his bank account in Delhi, maintained jointly with his mother to meet requirements of his family. Okay. What he's saying, sir, my family stays here in India, especially my mother, and I have a joint account with my mother. So can I ask my New York employer, that please give some salary in Delhi also. Give part of salary in New York account and part of it in Delhi also, so that my mother can spend for family requirements. So what will happen? If he will receive a part of salary in India, it will become taxable. Even in case of non-resident, we know that any income which is received in India, it becomes taxable, right? So we will advise him, please don't do this. Receive your entire salary in New York, and then thereafter, if your family needs money, then you can, as and when they need, please remit it in India, right? Even on monthly basis, you can remit it, but it should first be received outside India. It should be received in New York, right? So this is an easy question. It was 6 marks, and now you have to write it. Now I would like to request you, because now you understood the question, write in your own words. Write in your own words both the answers 1 and 2, and then you can cross check with my solution. Right. So let's start with the solution. I'll be doing it in the fast forward. Right. So let's start. Okay, I believe that we have done this. So first, I have discussed the first question, date by which Sagar should leave India. So first of all, how you will be presenting your answer, you have to first give the provisions. Write the provision first, that what are the basic conditions and what are the cases in which the second condition would not be available. Correct. Only 182 days conditions will be seen. Now, once you have given the provision to the examiner, then discuss your particular case scenario. So you can say that in the given case, it is assumed that Sagar is an Indian citizen. So 182 days condition would be applicable. So to reduce his tax liability, he should become a non-resident by staying in India for not more than 181 days. And then we have calculated that he should leave India by 28th of September 2023. We have shown the calculations also to the examiner, right? So mostly you should answer in the similar manner. First of all, give the provision and then link your case with then link your question with the above provision. Correct? Even if you see the suggested answers of the institute every time in mock test paper, in past year paper, you will see in the same manner that first they discuss the provision. It's not necessary that you have to quote the section number. It is not necessary that you have to write in a very legal manner. No, write in simple plain English, right? If you are writing correct provisions in simple plain English in your language, that will suffice. That is more than sufficient. Correct? Okay. And then we have discussed that what was the advice regarding the direct credit in the bank account. So first we have discussed that if any income is received in India, it will be taxable even if the assessee is a non-resident. So in this case, we will advise not to ask the foreign employer to credit the amount in Delhi's account. Please take the entire amount in New York, and then thereafter you can remit this to India. Correct. So this was question number 2A. Let's come to question number 2B. It says, briefly discuss the provisions of tax deduction or collection at source under the Income Tax Act 1961. Okay, so this question is TDS. You understand that TDS or TCS question is favorite question of examiner, and they generally in every attempt they give such kind of questions. So you can see these types of question in every attempt. Okay, so we have to discuss the TDS and TCS provisions and determine the amount, if any, TDS and TCS in respect of the following payment. So first we have to determine whether TDS or TCS, as the case maybe, would be applicable or not, and if applicable, what would be the amount of that TDS or TCS. Okay, first question says, Mr. Deepak wishes to purchase a residential house, okay, costing rupees 60 lakh from Ms. Priya. Now we understand that if there is a buyer and who is purchasing an immovable property, then there is a section which says that 1% TDS will be levied in case the value is more than 50 lakh rupees. Got it? And if you remember the section number in your examination, please mention that also, 194IA, right? This is the section number. In case you didn't remember the section number, it's okay. You can simply write in this manner. As per the TDS provisions, if the buyer is purchasing immovable property of the value of more than 50 lakh rupees, then 1% TDS would be applicable. And it will not, this section doesn't apply if the person is purchasing a agriculture land. Either it is rural agriculture land or urban agriculture land, this section will not apply. We understand rural agriculture land is anyways is not a capitalist. So it is exempt. But urban agriculture land is a capital asset and also capital gain arises in the hands of seller. But TDS provision doesn't apply on agricultural land. It could be any immovable property except agricultural land. So here you are purchasing, the assessee is purchasing a residential house, that too more than 50 lakh. So here 194IA 1% would be applicable. Okay, let's read it further. The house is situated at Chennai, okay, and its stamp duty is 65 lakh. Now again, one more point. So 1% would be applicable on 60 lakh or 65 lakh, whichever is higher. So the consideration you are paying or the stamp duty value, whichever is higher, 1% would be applicable on that amount. So 65 lakh, please calculate 1%. It would be 65,000, right? Okay. He also wants to purchase agriculture land in the rural area for 65 lakh. Both the buyer as well as the seller are resident in India. Okay, so both are residents, it's fine. He also wants to purchase agriculture land in rural area. Whether TDS would be applicable on this? No, because we have just discussed that 194IA TDS provision doesn't apply on agriculture land. So there would be no TDS on this 65 lakh. But on this 65 or 60, whichever is higher, for residential house, this is 65. Please apply TDS 1% on this one. Got it? Easy. Come to the second one. Second question says, ABC and company, it's a partnership firm. Okay. It's a company. Can it be a partnership firm? Yes. It's just ABC and company, ABC and Associates, ABC and Sons, ABC and company. It is not limited or private limited, right? It's a partnership firm. So this ABC is a partnership firm, is having a car dealership showroom. So they are the car dealers. They are car dealers. They are having a showroom. Okay. They have purchased cars for 2 crores rupees from XYZ car manufacturer. So there was a car manufacturer. You understand, this person is having a car showroom. So they must be purchasing cars from the manufacturer. Okay. So XYZ Limited is a manufacturer of cars. The cost of each car being more than rupees 12 lakh. So during this year, they have purchased cars worth rupees 2 crores and the cost of each car is more than 12 lakh rupees. So we understand there is a section in TCS, tax collected at source, where we have the provision. If a person is selling car of more than 10 lakh rupees, then 1% TDS is applicable. If you remember the section number, you can quote it, otherwise not necessary. The section is 206C1F, which says regarding motor cars, if it is more than 10 lakh rupees, because government wants to observe that if there is any high value transactions, that is the reason this provision is there in TCS. Second most important thing is that this provision is applicable when a dealer is selling the car to their customers, right? Then dealer is supposed to collect TCS at the rate of 1% if the value is more than 10 lakh. Let's say the value is 11 lakh or 12 lakh, then the dealer would be collecting 1% on that amount. Let's say 1% on 11 or 12 as the case may be. Here it is 12, so 1% on 12 lakh. But if the manufacturer is selling these cars to the dealers, so that is in the normal course of business, right? TCS provision doesn't apply there. So if you read that section, the section number is 206C1F. If you remember this section in your examination, go and quote it. If you don't, no problem, you can just skip that section number. Here you can first mention the provision. The provision says that if a person is selling the cars to the customer and if the value is more than 10 lakh rupees, then the dealer is required to collect 1% TCS. But this provision doesn't apply when manufacturer is selling to the dealer. So here we will say that when manufacturer is selling to the car dealer ABC and company, no TCS will be collected. Okay. Now they are saying they sell the cars to individual buyer at a price yielding 10% margin on cost. Okay. Now they are selling the cars to the individual customers. So when car dealer sells the cars to the customers, and that too, see the cost is 12 lakh, and anyways they are charging more than 10. They're charging 10% profit margin. Correct. So now 1% would be deducted on the amount on which they are selling the cars to the customers, right? So on the second transaction, the first transaction was from manufacturer to car dealers, no TCS. But from car dealers to the customers, TCS of 1% would be applicable. Now they have mentioned turnover of ABC and company and XYZ Limited was less than 10 crores during the previous year 22-23. Why they have mentioned this particular line? ABC and company and XYZ, this car dealer and manufacturer. Car dealer is a buyer, manufacturer is the seller, and their turnover of the last year, previous year 22-23, was less than 10 crore. Why they are giving this line? They want us to comment on that section also. We understand that if the buyer turnover is more than 10 crore in the previous year, then we have one more section where 0.1% TDS is applicable. If you remember the section number, it is 194Q, right? And if the seller's turnover is more than 10 crore in the last preceding previous year, then there is a TCS section also, 206C1H. If you remember the section number, quoted, otherwise not necessary, just write the provisions. So here, these two sections will also not apply. Why? Because neither the buyer nor the seller's turnover was more than 10 crores in the last year. Also, you can give a note regarding this also. Correct? So first question was regarding TDS, second question was regarding TCS. So let's do this question and then you can cross-check your answer with my solution, right? Okay, have you done, guys? So this is how you will be presenting your answer. It's very easy. First of all, present the provision, give the provision, and then relate your provision with your question. Correct. So here I have written the provision as per the TDS provision. If the buyer purchases a property, immovable property which is more than 50 lakh rupees, then 1% would be applicable, but other than agricultural land, right? Here I have mentioned this section number in different color because this is optional. If you remember the section number, go and quote it. If you don't, forget about it, right? So first write the provision, then relate your case, relate your question with the particular provision. Similarly, in the same way, we have answered the second one, that as per the TCS provision, if the seller is selling a motor vehicle which is more than 10 lakh rupees, then 1% TCS would be applicable. But however, this provision would not apply in case the manufacturer is selling to the dealers, right? First, you have given the provision and then relate your question with this provision. This is how you will be answering your question. I'll also share this file in the description itself so that you can refer this file as well. Okay, so let's come to the next question. Question number 3, A part. It says, Mr. Kamal is a, let's read it this way. Mr. Kamal is a resident but not ordinary resident in India. See, he is a not ordinary resident. So we understand if any income which is arising outside India and any income which is getting received outside India, then this person is not liable to pay tax in India. Why? Because this income is not getting arise nor it is received in India. So he is not going to pay tax unless and until that income is controlled from India. Correct? Because for not ordinary, we have this particular provision. If it is controlled from India, then you are going to make it taxable. Easy. Okay. So Kamal is a not ordinary resident. Okay. And this assessment here, he owns 2 houses. One house in Dubai and the other in Mumbai. Now we understand why they have given not ordinary resident, because this Dubai house, any income, let's say rental income is coming from this Dubai house, so that is getting arise in India. So he will not be liable to pay tax on this income, correct? Because he's a not ordinary resident. Only in a situation if this rent is getting received in India. If, see, for Mumbai house, we have no issue. This income would be taxable. If any income is coming from Mumbai house, or if it is a deemed let out house, then Mumbai house would be taxable anyways, right? It is also for non-resident as well. No problem with that. The issue with Dubai house is that because this person is not an ordinary resident, he is a not ordinary resident. Correct? He is not, I'm saying not ordinary. No. If this person is a not ordinary resident, this means that his Dubai income will not be taxable unless and until it is received in India. Okay. The house in Dubai is let out there at a rent at a rate of DHS 20,000 per month. DHS is Dubai dirhams, right? So dirhams 20,000 per month is the rental income. 1 DHS is also given as INR 22 rupees. If we need to convert, then we can simply multiply it by 22. That is not an issue. The entire rent is received in India. Okay, so this statement is very important. So we understand this person is a not ordinary resident. Dubai house income is not arising in India, so it should not be taxable in India. But because of this statement, they are now saying that this income is getting received in India. This income is getting received in India. That is the reason now we have to make it taxable. Correct? We have to make it taxable because the income is getting received in India. Okay. So Dubai house also would be, because there is a rental income of 20,000 per month, that is dirhams. We can convert that into Indian currency. Either you can do that from the very beginning, you can keep converting it into Indian currency, or it would be better, first of all, calculate the income from house property, and whatever the income is coming in foreign currency, here it is dirhams. So here you can, after computing the income, then at last you can convert this into foreign currency. Got it? That would be easy, but because it will save your time, otherwise you will be keeping on converting at every stage. He paid property tax of DHS 2,500 and severage tax of DHS 1,500 there for the financial year 23-24. So we understand these are municipal taxes, both of them are allowed. So how much dirhams is paid? 2,500 and 1,500. So that is 4,000 we can deduct from GAV. Okay. The house in Mumbai is self-occupied. If it is self-occupied for the entire year, do we start from GAV or we should start from NAV? We should start from NAV for self-occupied property if it is self-occupied for the entire year. NAV is nil, right? And after that, we have to give deductions, 24A, 24B. 24A is standard deduction. So that is called, that is 30% of NAV. So anyways, if our NAV is nil, 24A will be nil in that case. 30% of 0 would be 0, right? But yes, if there is any interest, then deduction could be allowed. And in that case, for self-occupied property, there could be a loss from house property because NAV is 0, 24A is 0, but 24B, if they are paying interest, then they can get the deduction. And for self-occupied property, how much is the maximum deduction they can claim? 2 lakh. In some cases, it is 30,000 if they have taken the loan for repairs, or if it is a very old loan. In that, but generally it is 2 lakh, right? The house in Mumbai is self-occupied. He has taken a loan of 10 lakh to construct the house on 1st June 2020 at a rate of 12%. Okay, now they are saying that there is a loan also. And how much is the loan? 10 lakh rupees, which he has taken on 1st June 2020, some 4 years back. The construction was completed on 31st May 2020. Now, okay, good question. They are giving a pre-construction period also. Why? Because the loan was taken on 1st June 2020, right? And the construction was completed on 31st May 2020. So we now know that there is a pre-construction period also. Okay, tell me, this pre-construction period will start from which date and will end up to which particular date? It will start from the day when we take loan. So it will start from 1st June 2020, and the house was completed on 31st May 2022. Where it is here. So should I make the pre-construction period till 31st May 2022? Is it correct? Sir, yes, sir, because he has taken a loan on June 2020 and the construction is completed on 31st May 2022. After that, it is post-construction, but till 31st May, it is pre-construction. Is it right or wrong? Wrong. It is wrong. Because we understand the year in which the property gets completed, the year in which this house is completed, that year will not form part of pre-construction. So where it, in which year it is completed? Sir, this is 31st May 2022. So tell me the previous year in which it is completed. Previous year is 22-23. So we cannot take even a single day of this previous year. Getting it? We cannot take even a single day of this previous year in pre-construction. Before that only we can take pre-construction. So this year is starting from 1st April 2020, right? So before that, it would be which date? 31st March 2022. Got it? Are you able to recall your provisions of pre-construction period? So the pre-construction period would be from 1st June 2020 till 31st of March 2020, right? And then we know, are you all clear with this period? Then you can compute the number of months which is falling under this particular period, and then you can calculate the interest. Okay. Please tell me, this pre-construction period interest will be allowed in this year, or we have to spread this particular interest in 5 equal installments? Sir, I'm so sorry. We have to spread this into 5 equal installments starting from the year in which it is completed. So previous year 22-23 would be the first year, correct? Next year is previous year 23-24. So we are doing for previous year 23-24, right? So our year is also coming in that 5 years bracket. So our year is the second year, I believe, right? First year was previous year 22-23, and our year previous year 23-24 is the second year. So yes, whatever is the current period interest, that is also, that should be allowed under section 24B. And also we have to calculate the pre-construction period interest, divided it by 5. Whatever is the amount, please include this and for your deduction under section 24B. Got it? I believe that you are able to revise this concept. Okay. We'll also do this question. Don't worry about it. So this seems to be a house property question, purely a house property question. The entire loan is outstanding as on 31st March 2024. See, in our year, still the entire loan is outstanding. So it means that the loan is for 10 lakh and the rate is 12%, right? So current period interest, how much it would be current period interest? So it would be 10 lakh into 12%. This is simple, 1,20,000. This interest relates to current year, and you have to calculate the pre-construction period interest also, divide it by 5, and please add this in this particular interest. This is the total deduction under section 24B. But please make sure that if it is going more than 2 lakh rupees, then you should restrict to 2 lakh because it is a self-occupied property. If this would have been a let out property or a deemed let out property, there is no problem. You can take the entire interest. But here it is self-occupied. So please restrict yourself to 2 lakh rupees. Good enough. Okay. Property tax paid in respect of the second house is 24. Second house means Mumbai house. So property tax is paid for rupees 2400. What you will do for this? Municipal tax is paid for Mumbai. Sir, we have to deduct from GAB. Okay. Sir, we deduct municipal taxes from GAB. So should you deduct for Mumbai house? No. Why not? Because if it is a self-occupied property, we don't start from GAB, we start from NAV, right? So this 2400, we don't have to do anything. We will simply ignore it. Not simply ignore it. We will give it a note that examiner, sir, this 2400 would not be allowed because this is a self-occupied property. Got it? Okay. Now, compute the income chargeable under the head income from house property in the hands of Mr. Kamal for assessment year this and this under regular provision of that. What is regular provision? Optional scheme. When assessee opt out from default tax regime. So regular provision is optional scheme. Because in default tax regime, we don't give so many provisions to the assessee. He has to sacrifice with so many deductions and other provisions. But regular provisions, we give all the provisions which are there in Income Tax Act. Regular provisions by examiner, if they say that please follow regular provision, they are saying follow optional scheme, where you follow all the provisions. Okay, so this is a pure house property question. So first of all, you have to calculate the income of Dubai because that will also be taxable, and you can please mention a simple note, a one-liner note you should mention that since assessee is a not ordinary resident, generally his income which is accruing outside India should not be taxable, but here the income is getting received in India, that is the reason we are making it taxable, right? Please give it a note also, not more than 1 or 2 lines, simple plain English. Okay, then you have to calculate the income from Dubai house. Either you can convert each and every, you start from GAB because that is a let out property, start from GAB. There are also municipal taxes. They were saying sewerage taxes and property taxes was there of Dubai house. So either you can keep on converting it into Indian currency at every stage, or I would suggest first calculate your house property income of Dubai house in foreign currency in dirhams, and then thereafter you can convert them into Indian currency by simply multiplying it by 22 because they have mentioned that 1 dirham is equal to 22 rupees. Then after that, please calculate for Mumbai house. So obviously in Mumbai house, there would be a loss, right? Because it's a self-occupied property, NAV nil, 24A standard deduction would be nil, but 24B there is an interest. So there would be a loss. So there would be some income in Dubai house, there would be a loss in Mumbai house. Simply you can club them together and then you can give a final figure, right? Otherwise, what is a better option to present it? You can present it by drawing columns. One column is for Dubai house, second column for Mumbai house. This is your wish. If you want to calculate first Dubai, then Mumbai, you can do that. Otherwise, if you want to calculate it simultaneously by showing it in a single one table, you can do that, right? So let's start with your answer, your presentation. Then you can check with mine. Okay, let's start this. Okay, have you completed this? It was easy. So I have made a table, one for Dubai house, then for Mumbai house. Even if you have computed first for Dubai and then for Mumbai, that is fine. So gross annual value for Dubai house is 2,40,000. This column I have made it in foreign currency, dirhams, and this is in rupees. So after that, once I have calculated the income from house property, then I converted it into rupees. And since there was a loss here and there was an income over here, so I have clubbed it together, and the house property income is coming as 34,70,400. Got it? And this is how the interest is calculated. The pre-construction period was starting from 1st June 2020 and it will go till 31st May or 31st March 2022. So it was 22 months. How I have calculated 22 months, that's a bit easy. You can calculate it. But my method is that actually while calculating these number of months, I generally take calendar days because I find this method easy. So see, which calendar year is falling under this pre-construction period starting from 2020 till 2022. So 2020, 2021 and 2022 are the calendar years, right? So in this year 2020, we can start from June. So from June till December, I'm just taking calendar year because I need just the number of months. So I can either take financial year or I can take calendar years. That is just to calculate the number of months, right? So you can use your own method. Actually, I prefer to calculate these months. Calendar year actually is a bit easy to calculate. So that is the reason I use calendar year method. So here it would be 7 months, here it would be entire 12 months, and here it would be 3 months, right? January, February, March. So if you add them together, it will be 22 months. So calculate interest on 10 lakh rupees because outstanding amount is same for the entire period. It is not changed. So 10 lakh into 12% into 22 months, it is 2 lakh 2.2 lakh for the entire pre-construction period. And we know that we have to allow it in 5 equal installments in 5 years, starting from the year when the house was completed. And this is our year, previous year, 23, 24. Actually, it is coming in that 5-year period. It is the second year of that period. So we have to give the deduction for pre-construction also. So current year interest for this year, it is 10 lakh into 12%, 120. We will add this 44,000 also. So it is coming as 164. It is not going above 2 lakh. So we are okay with it, right? So this is how, and also I have given the note, although I was running short of space, so I have written it over here, but in your examination, you have sufficient answer sheets. You can use as many supplementary sheets. So please, in your examination, please don't save paper. Save paper otherwise, but not in your examination, right? So in your examination, you can write this on the next page. Since rent of Dubai is received in India, therefore it is taxable. We have mentioned it because it is received in India. And municipal taxes of Mumbai would not be allowed because it is a self-occupied property. Just write those notes in a plain, simple, easy language. Not more than 1 or 2 lines. That's it. Okay, so this was a house property question. Let's come to the next question, 3B. It says, Ashish entered into an agreement with Dhaval to sell his residential house. So Ashish is selling their residential house. So there would be a capital gain. Okay. At Navi Mumbai on 16/8/2023 for rupees 80 lakh. So he entered into an agreement. He entered into an agreement that I'll be selling you the house for rupees 80 lakh. The sale consideration is 80 lakh rupees. Okay. The sale proceeds was to be paid in the following manner: 20% through account pay check. Okay. So we have decided that on the agreement date, you have to pay 20% and that too through account pay check. It's good that they are selling it and they are getting this token money in the form of, it is not in the form of cash, it is in the form of account pay check, right? Because it is easier if you have received any amount through account pay check, you can take the stamp duty value date of the registration date rather than the transfer date. Do you remember that? Because in case if you say that there is a prior period agreement, then you have to give evidence that, sir, I have received at least some part of consideration through a banking note. So here 20% of the proceeds is received through account pay bank draft on the date of agreement. Good enough. 60% on the date of possession of the property, balance after the completion of registration. That is not very important. Second and third is not very important. First was important, that the initial amount at the time of agreement was received through banking mode. Correct? Okay. Dhaval has handed over the possession of the property on 15/12/2023 and the registration process was completed on 14th of January 2024. So now we know that the registration date and the transfer date are different. So it is important that on the agreement date, the agreement date and the transfer date are different. So we understand that on the agreement date, because he has paid the amount, he has received the amount rather in the form of a banking mode. That is the reason we can take the stamp value of the agreement date rather than the transfer date. The value determined by the stamp duty authority on 16/8/2023 was 90 lakh, whereas on 14/1/2024 it was 91.5 lakh. See how important it is? Because the agreement date stamp duty value was 90 and transfer date value was 91.5. So which one we have to consider? So because since the initial amount at the time of agreement was received in a non-cash mode, in a banking mode, so we can take this value of the agreement date. So we don't have to take this value, we have to take this value. Okay. Now please tell me, the actual consideration was he is selling for 80 lakh and the stamp duty value which we have to take is 90 lakh. We understand that stamp duty value is higher, correct? So we have a section, if you remember the section number, then you can quote it, 50C. It is quite an important section. You see 50C questions often in your examination also. So 50C says that seller, if you are transferring your property at less than the stamp duty value, then we are going to take full value of consideration as stamp value, right? So in this case, we have to take 90 lakh and we will not take 80 lakh. Also, 50C gives a relaxation of 10%. They will say that we will give you a relaxation of 10%. How? Just calculate 110% of this amount. Just calculate 110% of your actual consideration. If this amount comes to be more than your stamp duty value, then we will take this value, right? But still, if the stamp value is higher, then we are going to take stamp value. So if we'll add 10%, or simply we can do simple mathematics, we'll multiply it by 110%, we will get 88 lakh, sorry. We'll get 88 lakh. Still our stamp value is higher, right? Still our stamp value is higher. So here we have to take full value of consideration as 90. Okay. So when you will be solving it, this seems to be a capital gain question. See, compute the income under the head capital gain. Okay. So this seems to be this is a capital gain question now. So when you will be taking full value of consideration as 90, first of all, you have to mention that why you are not taking this one. Because since at the time of agreement, some amount, even some consideration, some part of the consideration was received by other mode other than cash, that is through banking mode. That is the reason we are taking 90 lakh, that is the stamp value on the agreement date. Second, you can say that it is more than 110% of the actual consideration price. That is the reason we are taking the stamp value. So the full value of consideration will be 90 lakh. What is the cost? Ashish has acquired the property on 1/4/2001, long term, okay, more than 2 years. For rupees 20 lakh he has acquired. So you have to do indexation also. Indexation CI is already mentioned. After recovering the sale proceeds from Dhaval, he purchased another residential house in Kanpur for 15 lakh. So you understand. So first of all, you will be calculating your long-term capital gain. You know how to calculate this. Full value of consideration would be 90. You have to write the notes why you are taking 90. Second, less index cost of acquisition because it is long term. The holding period is more than 2 years. So it is long term. You have to index this 20 lakh rupees, whatever is the capital gain. Then because he has sold the residential house and he is purchasing another residential house. So we have exemption under section 54. So it says that the capital gain which you have got, and as well, please compare this with which amount? Compare this with for 15 lakh, whichever is lower. And there is one more amendment here. You have to You cannot give more than 10 crore also, right? If you remember that particular amendment in section 54, we cannot give more than 10 crore exemption. So 15 lakh, whatever is lower would be the exemption also under section 54. So I think you can easily compute this capital gain. Again, an important question. You often see section 50C questions in examination. So let's start with this particular question and then we will proceed to the next portion. So I believe you did this question. So this was easy. I think easily you can understood. I have already discussed most of the things. Section 54 exemption would also be there, and the capital gain is coming as long term 5,40,000 rupees. This was easy. And please mention that why you are taking full value of consideration as 9. I have mentioned it here. Okay, now come to question number 4. 4A, Mr. Mohit submits the following info for the previous year 23-24. Okay, there are certain incomes. What we have to do is compute the GTI. We have to compute only the GTI. Compute the GTI and the losses to be carried forward. It seems to be a set of questions. Okay, we have to compute the GTI and the losses to be carried forward for Mohit for assessment year 24-25 under regular provisions. What is regular provisions? Option scheme. Under regular provisions of the Act, Mr. Mohit has filed his return of income on 25/7/2024. Why they have given this information that Mohit has filed his return on 25/7/2024? See, what would be the due date? Either it would be 31st of July 2024 or it would be 31st of October 2024. Only for some assessors who have international transaction, it is 30th November. But generally, we are concerned with these two dates. At our intermediate level, that 30th November is more concerned at our final level. Okay. So let's keep these two ROI due dates in mind. So this assessee has filed his return much before than these due dates. Even if his due date, let's say even if it is 31st July, he has filed his return of income on 25th of July. That is much before than the due date. So he will be able to carry forward the losses, right? That is the reason they have given us this due date, that there is no issue, he can carry forward the losses. Okay, so this seems to be a set off and carry forward of losses question. Let's see. Income from salary 6,50,000. Okay, so this is not a loss, this is an income. Anyways, in salary we have income only. Income from house 1. Okay, house 1, house 2, house 3. He has 3 houses. House 1 has income 55,000. Loss from house 2, self-occupied. Loss from house 3. So he has losses from house 2 and house 3. So this is, I'm writing it as a loss. Okay, so he has loss. So first of all, what you have to do is you have to make intra-head adjustment. First of all, you have to make intra-head. And once intra-head is done, then you should come to inter-head. And once it is done, then you can carry forward your losses, right? So you all know what is intra-head, inter-head, and then carry forward. Intra-head adjustment means in the same year, if you have losses from one source and you have income from other source in the same heads, then you can first set it off. So intra-head is, see, house 2, house 3 has loss, house 1 has income. So this is intra-head adjustment. First, you have to do always while doing your set of questions. First of all, give preference to intra-head. So once intra-head is completed, then you can move to inter-head, but you understand that there are some certain restrictions for particular type of losses, correct? So then you have to move inter-head, and if inter-head is not possible also, then we have to carry it forward, right? So first of all, if I just look at house property incomes, because there are only 3 house property mentioned over here. Other is no, there is no other house property. So first of all, see, we have a losses of 125 and 190. How much is the total? 125 plus 190. It is 3,15,000. So 3,15,000 is the loss from house property and 55,000 is the profit from house property. So you can make an adjustment over here. It would be 260. So I can say in entire house property, we have 2,60,000 as a loss, right? Now tell me, although I have not read the complete question, but you have to tell me whether we can set off the losses of house property from other heads, or is there any restriction? See, please remember this. Let me revise this concept. See, here the assessee is following optional scheme. So in optional scheme, house property losses can be set off from any other heads also, except from casual. We understand from casual we cannot set off anything. So if you are following optional scheme, so in this question we are following optional scheme, that is also known as normal scheme. So house property losses can be set off from any other head income also. You can either set off it from salary, can be set off from PGBP, IFOS, capital gain, anything, right? But maximum only up to 2 lakh rupees. So we understand that this losses can be set off from other head. Even we can set it off from salary itself. So we have sufficient salary income, so we can set it off. So can we set off entire 260? No. Maximum house property loss which can be set off from other head is 2 lakh rupees. So in this case, either I can set it off from salary. Although if I would have been, if I have income from other PGBP or from other sources also, we can set it off from that as well. That is not an issue. So, but maximum the losses which house property can be set off from other head is 2 lakh. Please remember this. So anyways, if I am setting it off from salary, then only 2 lakh would be set off. 60,000 would anyways would be carried forward, because we cannot set off the entire 260. Only maximum 2 lakh can be set off. This would be carried forward for sure. This would be carried forward for sure. Okay. Second, please understand, if this examiner would have asked us that the assessee is following default tax regime. So tell me, in default tax regime, what happens to house property losses? Sir, house property losses can only be set off from house property income in that case. That is, intra-head is only allowed. Inter-head is not allowed for house property under default tax regime. I am repeating this. Students can make a mistake over here. If this question would have been of default tax regime, if the examiner has asked us that this guy is following default tax regime, then house property losses, if you would like to set it off from other heads, that is not allowed under default tax, not even a single rupee. So 2 lakh, no 2 lakh. 2 lakh is only under optional scheme, right? Even in default tax regime, even 1 rupee you cannot set. Got it? Okay. So I can easily set it off from 2 lakh. I can easily set it off from here from salary. Remaining 60,000 can be anyways would be carried forward. Okay. Loss from leather business is 68,000. Okay, this is the loss, PGBP loss. Normal. Is it speculative? No, sir. It's a leather business, normal business. So it's a loss. Profit from cloth business. This is PGBP. This is PGBP. Cloth business is how much? 170. So what we can do is, can we set off this negative 68,000 loss from 170? Yes, no issue. So this 68,000 entirely can be set off from this amount, and still 1,02,000 would be left. This is PGBP income, right? Would be left over here. Short-term capital loss in equity-oriented funds on which STT was paid. So it is short-term capital loss. How much? It is 35,000. And we understand that capital losses can only be set off from capital gain, right? Do you know that? This short-term capital losses can only be set off from short-term capital gain or long-term capital gain, any of the capital gain, but not from any other head. Correct? Long-term capital losses can only be set off from long-term capital gain, not even from short-term capital. To summarize this, losses under the head capital gains. See, if there are losses under capital gains, then they cannot be set off from other heads. Short term can be set off from either short term or long term, Long term can only be set off from long term. I hope that you are able to recall this provision. So what should I do of this short term losses? We will find if there is any short term gain or long term gain, then we will be able to set it off. Otherwise, we have to carry it forward, right? And for how many years we can carry it forward? Short term capital losses, 8 years. Income from crossword puzzles. This is, we understand, this is income from IFOS and that to casual income. So this is our income. Dividend from foreign company, 8,500 gross. So what it is? This is again IFOS income. So we have this IFOS, we have this IFOS. Loss on owning and maintenance of race horses. Tell me, this is a loss of 75. Okay, and the last one is income from owning and maintenance of race bulls, 9,000. Tell me, this is owning and maintenance of race horses. This is owning and maintenance of race bulls. Can I set it off this 7,500 loss from this income? The answer is no. Because we understand regarding race horses, if the assessee has loss from owning and maintaining race horses, such losses can only be set off from any other income of owning and maintaining race horses only, not from any other animal race. So this, and that too, for they can be carried forward. If they cannot be set off, they will be carried forward for only 4 years. So in this case, can I set it off this race horse owning and maintenance loss of 7,500 from this loss from bull racing? No, I cannot set it off. So it will be 100% carried forward. It would be carried forward, right? So we have IFOS income 12,000, 8,500 is an income, and 9,000 is also the income. Okay. So what about the short-term capital loss? Because there is no other capital gain, so we have to carry it forward. So first of all, you have to calculate the total income for the GTI. The examiner is asking just the GTI. So first of all, calculate the GTI in this question. And second, you have to mention that what are the losses which will be carried forward. So I understand that there are one of the losses, house property, 60,000, that would be carried forward. Short-term capital loss would be carried forward, and losses of owning and maintenance of race horses will be carried forward. So first of all, calculate your GTI and then mention by way of note that what are the losses which will be carried forward, right? So should we start this question? Okay, let's start this. So I believe that we have completed this question, answer number 4 also, this 4A. So we have salary income of 650, we have house property losses of 260, but we cannot set off more than 2 lakh in this case. If this person would have been following default tax regime, even I could not set off even a single penny, but here we are following optional tax regime, regular regime, so we can set it off 2 lakh rupees. So salary income would become 450. Alternatively, if you don't want to set it off from salary, house property losses can be set off from any other head also except casual income. So you can set it off from PGBP also, because PGBP we have 1,02,000. You can, but total from other heads it can be only up to rupees 2 lakh, not more than that. So if there is 1,02,000, so out of this 2 lakh loss, you can set it off from PGBP. You can also set it from IFOS, but only from which IFOS? Not from crossfoot puzzle, because you cannot set it off from any casual income. You can either set it off from dividend or yes, from owning and maintaining of raise bulls. From here you can set it off house property, but it's easy to set it off from salary itself, because otherwise you have to see from this particular, because even from PGBP the entire loss is not getting set off, right? So there is only 1,02,000 rupees. So it's better to set it up from the salary itself, right? Don't make it complex, make it easy. So salary income is 450. House property, there is a loss. So 60,000 we have to carry it forward. We have already discussed. PGVP, leather business loss, clothes business income. So still we have income of 1,02,000 rupees. Short-term capital gain, there is a loss which will be carried forward because there is no other capital gain income. And you understand IFOS, only race horses would not be set off. Why? Because it can be set off only from such business, that is race horses business only. That is the reason we are not able to set it off. We will be carrying it forward. So my income is coming as 581,500. This is GTI. And we have also mentioned that these are the losses, 3 losses which will be carried forward. Got it? Okay. So let's come to the next question, 4B. In fact, in 4B, there is an internal choice. Either we can attempt this 4B or we can attempt any one of them, or this 4B. But as of now, for practice, we will do both of them. Okay, these seems to be theoretical questions. What are the consequences of failure to intimate Aadhaar number? Is there any fee for such default? So yes. What are the consequences? So if you don't intimate your Aadhaar number, then your PAN becomes inoperative. So you have to mention that if you don't intimate the Aadhaar number, then the PAN becomes inoperative. And what are the consequences if PAN becomes inoperative? See, you will not be able to get the refund. Till the period the PAN is inoperative, we cannot, the interest on refund would not be calculated. You will not be given the interest for that period. TDS rate would be charged at, if somebody would like to deduct your TDS, they will be deducting at a higher rate. If somebody would like to collect the TCS, it would be collected at a higher rate. So these are some of the consequences if the Aadhaar is not quoted, right? I think you can easily write it down. Second is, what is the fees for default in furnishing return of income under section 234F? See, what is 234F? If you don't furnish your ROI within the due date. So what happens if you are submitting it late, then there is a fees of 5,000 rupees. So please mention that there is a fees for, see, this is 4B and it has 2 parts. Total it is 4 marks. So it is just 2 marks. So simply you can write 2 or 3 lines. That's it. So you can write that the fees for furnishing the return late is under section 234F is 5,000. And also, if the total income of the assessee is not more than 5 lakh rupees, then the fees would not be more than 1,000. Right? Okay, here also they were asking, is there any fees for such default of Aadhaar number? Yes, there is a fees. So whenever you will go to make to intimate your whenever you will go to intimate the Aadhaar number, and if you have not furnished it within time, then there is a fees of 1,000 in Aadhaar also, right? So here the fees is for late filing of return is 5,000, and if please also mention that if the total income is not more than 5 lakh, the fees is 1,000 rupees, maximum 1,000. Okay, last question. To whom the provision of section 139 AA, these are all are theoretical questions. You can easily do them. To whom the provision of section 139 AA relating to quoting of Aadhaar number does not apply. So we understand that although Aadhaar number is, quoting Aadhaar number is mandatory, but for some categories of person, some class of person, it is not required to quote the Aadhaar number. People who are residing in Assam, Meghalaya and Jammu and Kashmir, they are not required to put to intimate the Aadhaar number. Second is, if the assessee is a non-resident, then it is not required. If the person is a non-citizen, he or she is not a citizen of India, then it is not required. And the last one is that the person who has attained the age of 80 years or more during the previous year, they are quite old, they are not able to get their Aadhaar number. So for them, we are relaxing the provision. So these are the categories of person, classes of person who are not required to quote their Aadhaar. I believe that this is easily theoretical. You can easily do that. Otherwise, I'll mention them in the PDF file, which I'll be sharing with you, the answers of these as well, right? So this is we have discussed our series 1 MTP, we have discussed our series 2 MTP. I believe that you found these videos useful. I need your feedback, I need your comments. Please comment, please mention your comment. How do you find these videos? And students are asking me to post more videos on practice questions. Yes, I'll be definitely doing it till your examinations. I'll be posting it on either every day or on alternate days, some question or the other, so that you can get the benefit out of it. And also, some students are asking for TDS and TCS revision also, although I have already put the revisions of TDS and TCS. What I'll do is I'll make some videos on the questions of TDS and TCS. That would even be more beneficial, right? So I'll be doing that as well. Correct. If you need anything else, please let me know. I'll be able to post those videos also for you. But I need your comments. Please write your comments that how you are finding these particular videos, and do share with your friends. Till then, bye bye. Take care and all the best.